trade can be perfectly reasonable and still not deserve your risk. You may see a clean setup, a clear level, and enough evidence to believe price can move in your direction. But that is only half the decision. The other half is whether the move available is large enough to justify being wrong. Suppose, hypothetically, a stock is trading at 50. The structure suggests it might reach 52, while the trade needs roughly $1 of room to remain valid. Nothing about that setup is necessarily foolish. The problem is that the opportunity leaves very little margin for uncertainty. Markets rarely travel in straight lines. Price hesitates. It tests levels. Your execution may not be perfect. When the expected move is small, those ordinary imperfections consume a large part of what you are trying to capture. That changes the question you should be asking. Not, can this trade work? But, if I am right, is being right worth enough? A trader who ignores that distinction can spend an entire month making intelligent, looking decisions with poor economics. Each idea demands attention and accepts risk, yet none has enough room to produce a meaningful result when the market finally cooperates. The difficult part is that small opportunities often look safer because their targets appear closer. That appearance can be misleading. And once you begin rejecting trades that are merely possible, a harder problem appears. What do you do while you wait for something significantly better? The market can be quiet for hours, and that silence begins to feel like a problem you should solve. You scan lower time frames. You loosen your standards. A setup that would have looked ordinary in the morning starts to feel acceptable by noon, simply because nothing better has appeared. That is how the need to participate changes judgment. When you believe a trading day should contain a trade, inactivity starts to feel like failure. So you manufacture decisions where the market has offered very little. One weak position leads to another, and each one consumes something beyond money: attention, patience, and the ability to observe without interference. The danger becomes clearer when a real opportunity finally develops. You may have already taken 2 unnecessary trades. Now your mind is occupied with recovering a loss, protecting a small gain, or proving the day was not wasted. The market may be presenting its best structure of the session, but you are no longer seeing it with a clean mind. This is why patience is not simply waiting longer before entering. It is refusing to let the passage of time lower the quality of what you are willing to act on. Ask yourself something uncomfortable. If the market offered nothing worth doing for 3 straight days, could you remain completely inactive without inventing a reason to trade? Because once the pressure to act is removed, the next question becomes much more precise. What evidence finally makes waiting no longer the correct decision? Price pushes through a level you have been watching, and the first impulse is to treat the break itself as confirmation. That is where judgment can become distorted. A sudden candle looks decisive because speed creates urgency, but movement beyond a level only tells you that price crossed it. It does not yet tell you whether the market is willing to stay there. That distinction matters because a breakout needs more than distance. It needs acceptance. If price moves above resistance and immediately loses that ground, the market has revealed something very different from a move that holds, attracts continued participation, and begins building from the new area. So the decision is not about predicting the next candle. It is about deciding what evidence must appear before the move earns your trust. Consider a hypothetical breakout through 100. Price jumps to 101 toti within minutes. The candle is strong, volume expands, and everything looks obvious. But if the next sequence cannot hold above 100, the first burst may have shown excitement rather than control. The difficult part is that waiting for evidence can feel uncomfortable precisely because the move may continue without giving you the entry you wanted. And that creates the next test. When confirmation finally arrives, but price has already moved farther than you planned, are you still evaluating the trade, or reacting to the fear of being left behind? The breakout happened exactly as you expected, but without you. Now price is higher, moving fast, and every new candle seems to confirm what you already knew. The temptation is to enter immediately. Not because the original setup is still intact, but because watching the move continue without you has become more painful than taking the trade. that changes the decision. The clean entry belonged to an earlier price. Once the market has traveled far enough, you are no longer buying the same opportunity. You are accepting less remaining upside while often needing more room for normal movement. The idea may still be correct, but the terms have changed. Imagine a hypothetical breakout plan near 80. You hesitate, and price quickly reaches 84. Nothing fundamental about your analysis has changed. Yet entering at 84 simply because the move looks strong means your decision is now being shaped by the 4 points you missed. That is the trap. A missed trade feels unfinished, so the mind tries to repair it. But the market has no obligation to give you back the entry you failed to take. Sometimes the disciplined decision is to watch a move you understood continue without you. The harder question comes when the opportunity still appears attractive after the entry has changed. If you decide to participate, how much exposure can you carry before the size itself begins controlling your decisions? A position can be based on an excellent idea and still become impossible to manage because you made it too large. The larger the position, the louder every small movement becomes. A routine pullback feels significant. A few ticks against you demand attention. Instead of observing the market, you begin observing your profit and loss. That changes behavior. Suppose, hypothetically, you take a position expecting a broad directional move over several days. The structure naturally allows some back and forth movement, but your exposure is large enough that an ordinary fluctuation produces an uncomfortable change in account value. Now the market has not changed, but you have. You begin checking every candle. You feel pressure to protect the position from movement it was always supposed to tolerate. Eventually, you interfere, not because new information appeared, but because the size made normal uncertainty emotionally expensive. This is the contradiction. The bigger the move you hope to capture, the more room you may need to remain mentally steady while it develops. If your exposure makes every minor fluctuation important, you have created a position that demands precision from a market that offers none. Conviction should sharpen your attention to the opportunity. It should not make you dependent on immediate agreement from price. So before thinking about how much a major move could produce, ask a harder question. How much exposure allows you to observe that move without your own position distorting what you see? And once size stops controlling your judgment, the next test becomes whether conviction itself can survive contrary evidence. A large potential move can make you more reluctant to admit when the original idea has stopped working. You entered because certain conditions were present. Then price behaves in a way that contradicts those conditions. Instead of treating that contradiction as information, you begin protecting the possibility of what the trade could still become. That is where conviction turns dangerous. Imagine a hypothetical breakout that was supposed to show sustained strength above a major level. Instead, price loses that area, remains below it, and repeatedly fails to recover. The evidence that justified the trade is weakening. But because you imagined a much larger move ahead, exiting now feels like abandoning something valuable. So the mind starts negotiating. Perhaps the market needs more time. Perhaps the weakness is temporary. Each explanation delays the decision, and each delay increases your dependence on hope rather than observable evidence. The size of the expected reward has no power to preserve a broken premise. A trade does not remain valid because the outcome would have been important. This is why invalidation must be understood as a change in the facts, not as an admission of personal failure. When the condition that justified your commitment disappears, your responsibility is to notice that disappearance before imagination replaces observation. Ask yourself, if you had no position at all, would the market as it stands now still support the same idea? And if the evidence begins strengthening instead of weakening, a different decision appears. When has the market actually earned more of your commitment? Adding to a position feels easiest when the first entry is under pressure. Price moves against you, and a lower price creates the illusion of improvement. You can reduce your average entry, increase your exposure, and tell yourself the opportunity is now better than before. But the market has given you worse evidence, not better evidence. When you add simply because price moved against you, You increase commitment at the exact moment your original judgment is being questioned. The decision is no longer based on fresh strength. It is based on the desire to make the first decision work. Now consider the opposite situation. Hypothetically, you enter after a clean breakout. Price holds the new area, advances, pauses without giving back much ground, and then begins pushing again. Your first position is no longer supported only by your original analysis. The market has added new information. That is a very different reason to increase exposure. The principle is not that adding is always wise. It is that additional commitment should have to earn its place. If the evidence improves, the case for further participation may improve with it. If the evidence deteriorates, a cheaper price alone does not make the trade stronger. Ask yourself what you are rewarding when you add better market behavior or your own discomfort with being wrong. Because if the market does earn greater commitment and the position begins working, another problem appears. The growing profit itself can start pressuring you to leave before the real move develops. A profitable position can become hardest to hold just when it begins proving you right. At first, you were willing to accept uncertainty because nothing had been gained yet. Then the trade moves strongly in your favor, and the open profit starts to feel like something you already own. A normal pause now feels different. A modest pullback feels like money being taken away. That emotional shift changes the objective. You entered to participate in a large move. But once the position is profitable, the goal quietly becomes protecting what is already visible. Because protection feels safer than uncertainty, you can exit a healthy trend for reasons that have little to do with the trend itself. Consider a hypothetical position that advances from 60 to 72, then pulls back to 69 after several strong sessions. Nothing unusual has necessarily occurred, yet watching 3 points disappear can create more pressure than the original risk ever did. The danger is judging every retreat by the amount of profit surrendered instead of by what price behavior actually means. Major moves rarely unfold without interruption. If every pause is treated as a signal to escape, you may repeatedly capture the easy portion and abandon the part that made the opportunity exceptional. So when profit begins creating urgency, ask what has actually changed in the market, not what has changed on your screen. But even a position managed with a discipline faces another question: what surrounding conditions allow one strong move to keep expanding while another simply runs out of force? A breakout can look excellent on its own chart and still be occurring in the wrong kind of market. That is easy to miss because the setup is visible. The level is clear, the price action is clean, but the environment around that setup may be offering very little support for sustained expansion. Suppose, hypothetically, a stock breaks above a well-defined range while the broader market is flat, volatility is contracting, and similar stocks are repeatedly failing to follow through. The breakout itself may be technically valid. The problem is that the surrounding conditions are not producing much distance. A pattern does not create its own environment. When markets are expanding, strength can attract more strength because participation is already increasing. When markets are stagnant, the same local move may struggle because there is less pressure pushing prices away from established ranges. This changes what you observe before giving a breakout too much importance. Is movement broadening across related names? Are ranges expanding or shrinking? Are strong moves holding their ground or repeatedly returning to where they started? The local chart tells you where the opportunity appears. The wider market helps tell you whether that opportunity has room to become something larger. Ignoring that distinction can make you blame execution for a trade that was fighting an uncooperative environment from the beginning. And when an apparently strong opportunity fails in those conditions, the next decision becomes critical. Do you abandon the idea completely, or can the failed attempt create a better second opportunity? A failed first attempt can leave you with two equally dangerous instincts: get back in immediately or refuse to touch the idea again. Both reactions come from the first trade, not from the market as it exists now. Suppose, hypothetically, price breaks above a major range, fails, and returns inside it. You exit. Several sessions later, price stabilizes, selling pressure fades, and the market approaches the same area again under a different structure. The second decision should not be a continuation of the first one. If you re-enter simply because you want to recover what was lost, you are trading memory. But if you reject the setup automatically because the previous attempt failed, you are still trading memory. In both cases, yesterday's result is controlling today's judgment. The useful question is what changed. Did the failed attempt weaken the opportunity, or did it remove weak participation and allow a stronger structure to form? Is the second setup giving you new information, or merely another chance to express the same old opinion? A stopped-out position does not give you special knowledge about what happens next. It only gives you a history with the trade, and that history can distort what you see. So mentally erase your previous entry price, your previous loss, and your need to be proven right. Then look again at the market in front of you, because the next decision test begins with one question, If this were the first time you had ever seen this chart, would you still want the trade?